Gold Rush 2025, a volatile climb. The year 2025 promises to be an exciting one for gold. All signs point to a volatile upward trend in prices. This surge is driven by several factors. Understanding these factors is key to making smart investment decisions. Buckle up because the gold market is about to take off. One key driver is the increasing demand from central banks. These institutions are buying gold at record rates. They are diversifying their reserves away from the US dollar. This de-dollarization trend is boosting gold's appeal as a safe haven asset. Additionally, the Federal Reserve's interest rate policy is playing a crucial role. The Fed is expected to cut interest rates. This makes holding gold more attractive. Lower interest rates reduce the opportunity cost of holding gold, which doesn't earn interest. This combination of factors creates a perfect storm for a gold price rally in 2025. Central banks and Fed fueling the surge. Central banks are on a gold shopping spree. They are buying hundreds of tons of gold each year. Emerging markets, in particular, are increasing their gold reserves. These countries see gold as a hedge against currency fluctuations and economic uncertainty. This trend is expected to continue in 2025 and beyond. As central banks diversify their holdings, the demand for gold will remain strong. This sustained demand will provide a solid foundation for gold's upward trajectory. Adding fuel to the fire is the Federal Reserve's stance on interest rates. The Fed is expected to cut interest rates in 2025. This move aims to stimulate the economy. However, it also makes gold more appealing to investors. Lower interest rates make holding gold less costly. This is because there is less potential return to be earned from interest-bearing assets. As a result, investors are more likely to turn to gold as a safe haven for their wealth. This shift in investor sentiment will further contribute to gold's price momentum. The shrinking supply, a price booster. The gold market is facing a supply crunch. New gold discoveries are becoming increasingly rare. Meanwhile, existing mines are being depleted. This mismatch between supply and demand is putting upward pressure on prices. As gold becomes scarcer, its value is likely to increase. Adding to the supply constraints are rising production costs. Mining companies are facing higher energy costs and labor expenses. These rising costs are squeezing profit margins. As a result, some companies are scaling back their operations. This reduction in supply further exacerbates the imbalance in the market. The combination of declining discoveries, depleting mines, and rising production costs creates a challenging environment for gold supply. This supply shortage is a significant factor driving the projected price surge in 2025. As demand continues to outpace supply, gold's upward trajectory is likely to persist. Section 4. Riding the wave: gold stocks and ETFs. Investors looking to capitalize on the gold rush have several options. One popular approach is to invest in gold stocks. These are shares of companies involved in gold mining and production. When gold prices rise, these companies often see their profits soar. Another option is to invest in gold ETFs. These are exchange-traded funds that track the price of gold. ETFs offer investors an easy and liquid way to gain exposure to the gold market. They are particularly attractive for investors who want to avoid the complexities of owning physical gold. Both gold stocks and ETFs can provide significant returns in a rising gold market. However, it's crucial to conduct thorough research and choose investments wisely. Diversifying across different companies and ETFs can help mitigate risk. Section 5. Navigating the risks: a bumpy road ahead. While the outlook for gold is positive, there are risks to consider. The Federal Reserve's monetary policy is a key wildcard. If the Fed raises interest rates sooner or more aggressively than anticipated, it could dampen demand for gold. Investors should closely monitor the Fed's actions and statements. Geopolitical events can also impact gold prices. Gold is often seen as a safe haven asset during times of global uncertainty. If geopolitical tensions escalate, it could drive up demand for gold. Conversely, if tensions ease, it could lead to a decline in gold prices. The US dollar's strength is another factor to watch. Gold is priced in US dollars. If the dollar strengthens, it makes gold more expensive for buyers using other currencies. This could potentially weigh on demand. Investors should keep an eye on currency movements, particularly the US dollar index. Despite these risks, the long-term outlook for gold remains bullish. The fundamental factors driving demand, such as central bank buying and supply constraints, are likely to persist. By carefully navigating the potential risks, investors can position themselves to benefit from gold's volatile, yet ultimately rewarding journey in 2025.